Welcome, everybody. We're really glad to have you. Really excited to bring this topic to you. Modern infinite banking advantages for doctors. When we're focusing on doctors, if you're a medical professional in some other capacity, whether it be a chiropractor or a dentist, obviously you're going to benefit the same way. So we want to be inclusive with that. We do see a lot of interest and excitement for those in the medical community around this and around the infinite banking strategy. So we're excited to dive into this topic. Barry Brooksby is with me today. Barry, welcome.
Thank you, Steve.
Glad to have you. Barry and I do a lot of webinars together. If you guys are new to Insurance and Estates, probably we'll see a lot of both of us on these webinars. We like to tag team these topics and are excited to do that. Barry's really our resident infinite banking expert, high cash value, whole life expert. For Barry and I, we're both fans of infinite banking and take it from a case-by-case strategic planning standpoint, which is in our shared value of educating folks and helping people protect what they have and maximize that with this strategy.
Steve, I'll just add that with our housekeeping here, the information that we're going to share is unique. This is not traditional financial advice, so we recommend you put down your cell phones, shut down Facebook or any other social media apps, and really focus on what we talk about today. When you look at what the truly wealthy are doing in this country, a lot of them focus on what we're going to talk about today because of the many benefits that you get.
So our goal today is really fourfold. We're going to first review the risks for doctors, really for everybody, but doctors are particularly risk averse. I've helped a lot of doctors in planning over the years and options, why we need a viable alternative to simply doubling down on a risky strategy when it comes to estate planning, when it comes to retirement and financial matters. And so we're going to dive in first there. Then we're going to highlight what Barry and I like to call modern infinite banking, what that is, how it works, and dispelling some of the myths that are out there, clarifying the core concept, why it's sound, predictable strategy with many advantages. Then we're going to talk about some of the specifics of modern IBC, which is infinite banking, offering predictability through guarantees, talk about tax advantages, and many of the other aspects of this that kind of weave together to form a really exciting financial safe bucket, we like to call it. Finally, we want to talk about doctors' unique benefits, such as asset protection, chronic care planning, things that are probably very important to most of you listening if you're in the medical field, and how these are very unique advantages that you can add to the mix when you're doing this kind of planning. Barry, you want to talk about uncertainty a little bit and predictability?
Yeah, and this is crucial because it comes into play as to what we're dealing with today and then potentially what you're going to deal with in the future as a doctor. I've learned in my 20 plus year career that when you have predictability in your financial plan, you function better, not only consciously, but also subconsciously. And it affects every aspect of your life, physical, spiritual, mental, emotional. And when there's uncertainty and those unknowns, whether it's losing sleep at night or anxiety or stress, whatever the case might be, it can be difficult to practice as a doctor and really focus in your expertise. And that's the goal, is to focus in your expertise and not worry about all of these other things. I see too many doctors out there getting sidetracked by the bright, shiny objects, which I call alternative investments, or someone might bring an opportunity to them and then they lose sight of their practice. I think most doctors would agree, Steve, that their highest rate of return is in their own business. Therefore, why have more uncertainty in their plan if it isn't necessary? And that predictability that we'll talk about today will actually, I believe, enhance their practice and their lives overall.
Yeah, that's a great point, Perry. Medical pros out there, I'm sure, are well aware of the full court press, marketing-wise, that happens for medical people. Every opportunity under the sun, everything spanning from investment opportunities to tax planning to trust strategies, whatever it is. I think it's important for medical people to be wary of these things. And I agree with you. It can be very distracting, I would imagine, to be having to look at these complicated, risk-inherent strategies and wonder if you should be pursuing those things, but yet taking away from probably the most profitable and predictable thing that you could be doing, which is, in many ways anyway, which could be the medical practice. So our goal, obviously, myself as a planning-minded person and Barry as an expert with these products and strategies is to help bring predictability and really a peace of mind to a medical professional who's listening. And that's really the goal, to take the focus off of the risks and the things that are really going to add more uncertainty and to bring predictability and peace of mind over these areas, at least to a large portion of your plan.
And some of those risks we're going to consider. One is the US debt clock. This is real time. You can go to usdebtclock.org yourself and look at these numbers. Currently, the United States national debt's over $28 trillion, and several trillion have been added to this just in the recent months. That number is scary, one, because it's so hard to fathom, but two, Steve, how does it get paid for? That's a really big issue. How does it get paid for? But even a scarier number is this number here in the bottom, which are US unfunded liabilities, that the US is on the hook to pay future liabilities of almost $160 trillion. Again, unfathomable to really wrap your mind around, to consider that amount of money.
It is. And I feel like many folks probably are just at this point thinking that we're just giving up on trying to balance, or to repay or to come up with a plan. It's just overwhelming.
Seems like it. We also have the retirement gamble. There are several stories that have been done on this. The one that I'm going to share quickly is from Frontline. They did a story on the retirement gamble, which really spoke to the problems with traditional investments. The tagline here, the retirement gamble, raises troubling questions about how Americans' financial institutions protect our retirement savings. When you consider what's happening here, there was another story done by 60 Minutes, and they talked about 401ks and problems with the market, et cetera. We'll get into that in a minute, but really take a look at those different retirement gamble issues that are out there. The next one is the pension gamble. Now, not a lot of doctors have pensions necessarily. Some do if they might be working for a hospital, et cetera. But pensions really are in trouble as well. Again, another story that could be viewed on this by Frontline, talking about how the role of state governments and Wall Street in driving America's public pensions into a multi-trillion-dollar hole. They're not sure where to invest. They're losing money, and they're looking at what they're on the hook for to pay out pensions for the future, kind of like the US debt clock, and that future amount that's going to be owed. How does it get paid for? And then we get into the next one, which are really stock market and 401k problems.
We talked about this before. We devoted some webinars to this.
Yeah, number one, with the stock market, a lot of doctors invest there. The problem is we don't know what the future holds. Can you earn a 20 or 30% return in the market? Absolutely. That's happened in the last few years. Can you also lose 20 or 30%? Yes, we saw that happen in 2008 and even at the beginning of 2020 with COVID. The whole issue here is that uncertainty, that it isn't predictable. We don't know what the future holds. And if you believe that your practice as a doctor is your highest rate of return, why take the risk? Yet a lot of doctors do. And I'm just going to outline a couple articles here with 401ks. This comes from Forbes, how your 401k may be hurting you. And this author really dives into fees. He even says that it's no surprise that the worst 401ks even attract lawsuits, that there are lawsuits for 401k issues currently. And we also, here's another article, market problems, that it's the investors that are to blame. But the big thing that you hear from a lot of CPAs, Steve, as they're advising doctors is the following the crowd mentality, right? Everyone has an IRA, everyone has a 401k. I'm going to save you money this year. But what they don't tell you is you're deferring your tax for a future unknown tax date. And the problem with that is we don't know what taxes will be. And over that time, you're locking your money up. If you're 35 or 40 or 50, that's 15, 20, 25, 30 years of locking your money up that you don't have access to it in a qualified plan.
And from a planning perspective, I just encourage you, if you're a doctor, a medical professional watching this, you got to be careful. A lot of different levels of expertise. And of course, when you go to a tax advisor, they're oftentimes trying to save you some taxes for the current year. What we're really talking about is taking a little deeper look and a little more holistic view on the big picture when it comes to 401ks in particular and the taxation issues that can arise.
Correct, which brings us right to taxes. And look,
Yeah.
let's be clear, Steve. We're not saying to people out there, don't invest in the stock market, don't invest in a 401k. But what we are saying is there is another place you should be putting your money that's safe, predictable, tax-free, liquid. We'll get into that here in a moment with infinite banking. But in regards to taxes, taxes can erode, depending on our tax bracket, 40, 50, 60% of our income. And I'm not just talking about federal and state tax that we pay every year, but what about gasoline tax, sales tax, property tax, all those other taxes we paid? There's a big erosion of money that we're able to hold on to. What we advise, based on our low tax rates today, pay taxes today in a low environment. And in the future, you now have created a tax-free bucket of money that you don't have to worry about. Will taxes be higher? It's a problem that can be solved today. And I think what you're saying in regards to CPAs is there isn't necessarily true tax planning. They're just looking out for this particular tax year.
Particularly in the CPA arena, I think you do see that in the current year. I don't know if any of you listening had ever been in one of these webinars or sites where they're actually adding up all the taxes in various states. And it's pretty daunting when you consider they're just coming from everywhere when you really look at it. And so, yes, tax erosion. We also see it on the estate tax side, very high threshold right now that could very likely come down as far as being able to pass assets to future generations. There's income taxes, which I know many of you are concerned about. And of course, there's always estate taxes too, and how to pass wealth to future generations. So two different things going on, and taxes are something to really be thinking holistic about and be on top of. And in addition to taxes, having dealt with a number of doctors over the years, litigation is a huge concern. On the whole, I would say doctors that I've worked with are probably 90% more concerned about litigation than anybody else. And that's just inherent in the medical field and the liability that's there, the potential for things like malpractice, and doctors having a good base of assets and wanting to protect those assets. Perhaps as a bonus, we're going to talk a little bit about asset protection. A lot of people don't think about what categories of assets do they have that are actually protected from judgment creditors. We'll touch on that a little bit because that's something that if you have a trading account, stock account, or other kinds of assets, you might not have any asset protection. Retirement accounts have some. So this is something that you need to be aware of.
And Steve, some of these we've talked about, but just as a recap, other things to consider when it comes to uncertainty: investment fees. A lot of those qualified plans have hidden fees. Obviously, volatility we've addressed. We don't know what the market will do from one year to the next. And inflation. And look, a lot of people are investing in the market. They want to out-earn inflation, which I understand. That's why, again, we're not telling doctors to put all their money into infinite banking, but consider it as a very viable source for more flexibility and also more diversification into a safe tax-free money bucket. But then longevity. People are tending to live longer today, Steve, with modern medicine, and doctors know this. How do you overcome longevity where you're not going to run out of money in the future? Or if tax rates are so high that a large portion of your portfolio that you have saved and invested is taxable, you may not have the money that you thought if you live a very long life.
There you go. These are areas of, again, unpredictable risk categories, right? That everybody, in particular doctors, medical people, need to think about. Doctors have unique planning and financial concerns, and we've already touched on them to an extent. Estate planning, wealth transfer, transferring oftentimes large amounts of assets to future generations. Of course, asset protection, meaning protection from judgment creditors and lawsuits. And then, of course, tax planning due to high income. So mentioning these to keep them in mind as we're considering some of the strategic things that we're going to dive into.
So what's the solution for all the issues and concerns that we've brought up? And before we get into that, I want you to take a look at these names that you'll know. You know these people, you know these companies, and what they have in common is that they are all using high cash value whole life insurance in their business and or their personal lives. And you have to ask the question why, which we'll get to in a moment.
I just want to mention to anybody that's new to infinite banking, just listening to this, when we give you those names, those are blue chip companies and banks that have large portfolios of whole life insurance. This kind of whole life is just used very commonly to leverage, basically to take advantage of what you can do with one of these high cash value policies, right, Barry?
Absolutely. Yep.
And the individuals mentioned too, rather prolific individuals who have actually relied upon whole life insurance. Whole life insurance is a long-standing, high-value asset that is amazing to me that it's often glossed over in today's planning environment. It's almost as if people want to ignore it, but it's such a powerful, long-standing asset. It should be taken into consideration.
I agree. What is infinite banking? Nelson Nash created the concept in the 80s. Although whole life insurance itself has been around for nearly 200 years, Nelson realized that a uniquely designed, properly structured whole life cash value policy had a lot of benefits. These whole life policies have to be with a participating, dividend paying mutual life insurance company. There's a reason for that. And it's a way for people to become their own bank by taking control of the banking function in their lives. The book we recommend you read, Becoming Your Own Banker, it was first published in 2008.
The one thing to keep in mind for our scholars out there and somebody that's going to read it in detail is that it was written during a very high interest rate environment. These policies have evolved over many years since the original, and then, updates to the book. So when we talk about modern infinite banking, what we're really doing is taking what Nelson Nash did, which is a very groundbreaking thing, and putting it into today's context of low interest rates and how these policies have evolved, how the companies have evolved. For you people that are very detail oriented out there, I just wanted to preface that as you dive into this and start to unpack this concept for yourself.
Yeah, and we're still going to show the immense power that it has today, even in a low interest rate environment.
Right, and we've talked about that, Barry. It's actually better, right? Because what we're doing is when you decide to meet with Barry and when you see a policy illustration, it's going to be very conservative in nature. We're not relying on huge high interest rates or soaring dividends in order to illustrate. We're actually taking this at a very conservative level, and you still see the power of it.
Infinite banking is also known by these other names: Bank on Yourself, the 770 account or 702J account, cash flow banking or cash flow insurance, family banking, private family banking, or the family banking system and cash value plans. It's all the same thing. Now, what I have found is that there are a lot of advisors out there using the wrong company, using the wrong structure. Although they might call it infinite banking or by one of these other names, it still isn't correct. You want to be sure that when you're looking at your own illustrations and your own numbers, that you're meeting all that criteria we went over earlier. Mutual company, A+ rated, dividend paying, participating, correct structure, all that's very, very important.
I just want people to be aware of the fact that this is a very interesting arena. And of course, everything boils down to who you're talking to, like most things when it comes to professional advice. And one thing that we're committed to, and I've always been committed, and I know you are, Barry, but when we started Insurance and Estates, we want to shop and use the best company for you as the client, right? We're not just trying to pick a company that works for us as the practitioner. I just want to give people that commitment that we have, and that's really what we're all about, is hearing from you as a potential client and then shopping to find the best mutual participating whole life company.
Agreed, Steve. We're wanting to make sure of that because we want to meet the client's goals. We want to make sure that they get the best policy day one with the right company. And mutual plays a big role in that. You want to address some of the mutual life companies?
Well, yeah, so why a mutual whole life company? For those of you, again, who are fairly new, you've got differences, right? And the mutuals are policy, basically catering to the policy holders, sort of a cooperative feel. So it's a different kind of an animal than a stock company. Stock companies, as I'm sure most people are well aware, is they're catering to the shareholders. So mutuals are really specifically beneficial, in our opinion, just from the standpoint of designing the strategy. And we're going to talk a little more about dividends. We're going to talk about the policy owners being members of, really like members of the company, the mutual insurer being beholden to the policyholders. So operating approaches, the stock companies would rely upon the desires of shareholders. The policyholders are basically just holding the policy, but there's no real ownership relationship. And unless, of course, the policyholder owns stock as well, but that's going to be a separate thing for them. It's not going to relate back to their policy in particular, at least directly.
Correct. And when those profits or dividends are paid out in a stock company, they're going back to the stockholders. You might have a policy with a stock company, but not participate in those dividends or profits. Where with a mutual, that's one of the benefits is we get the profits and the dividends in a mutual participating company.
So the other thing is the way that the company conducts itself. Mutual companies have a long record of being more apt to consider the health, the business when it comes to making strategic decisions. They're not just looking to get the share price up there. You're talking about a conservative approach to investing funds. Some mutual companies more than others. The companies that we're most focused on, I think, Barry, you would agree, is that they tend to be lean and mean at this point as far as their budget and their marketing approach. It's an important thing to consider, when looking at these companies.
Yeah, and some of these companies we use today, they've paid dividends every year for over 150 years. A+ rated, they've weathered the storms of world wars, the Great Depression, the crash of '08, and never missing dividends, which you think that is important when it comes to a company that you're going to hold in your portfolio for your future.
Right. For you guys that are new to this, I just want to preface a couple things too. If you're doing any web-based searching, you just want to be wary. You're going to hear people bashing mutual companies. You'll have people bashing infinite banking. And a lot of times there's a battle for dollars out there. And frankly, certain groups or certain industries can be very aggressive about that. Obviously, we want you to do your own research. We want you to have the knowledge you need. But when it comes down to mutual companies, you might hear something like, well, it's a return of premium because you overpaid, right, Barry? So when you're talking about dividends, it's a return of premium. Well, the fact of the matter is that with a mutual company, if the company does better than what they had forecasted, then that money is coming back, at least in large part, to the policyholders in the form of dividends. We're going to get into some tax benefits related to dividends. And it's huge because what it allows is money to be reinvested, put back in the policy, and fostering compounding growth within the policy. So what I'm saying is if you're hearing things that are critical in nature, make sure you're getting all the facts. Make sure you're really understanding what a mutual company is and the differences. And of course, that's what we're really trying to kick off for you.
And the mutual insurance companies are investing dollars. It's not like they're just sitting on cash under a mattress and not earning any returns. They are, in fact, earning returns.
Right. So this illustration is just to recap the benefit, the tax advantages of dividends companies manage for the benefit of policyholders.
Correct. So how do you capitalize on it and establish a plan? First and foremost, you want to consider a premium amount that you would put into a policy either monthly or annually. Now, as I talk to doctor clients throughout the country, a lot of doctors are investing in 401ks, IRAs, and let's take another example like a solo 401k. The max contribution limits today for a solo 401k is $58,000 a year if you don't have any employees and you own your business. If you have employees or you are employed with someone, it's $19,500. If you're 50 or older, there's a catch-up provision of another $6,500. So you're talking $64,500. Whatever premium amount you decide to put into a plan, that's up to you. What we do at Insurance and Estates is take that premium amount and maximize it for the greatest cash value growth. What you decide on is a personal decision. One of the things you might want to consider as you think, gosh, I'm not sure, take 20% of your gross income and look at numbers based on that, or 10%. If you want to go higher or lower, that's up to you, but at least 10 or 20% will give you some idea as to numbers to consider.
Barry, I'll just jump in for a second here. Because people often ask that, right? They'll say, well, how much should I put into it? We have a lot of books on the website. Our philosophy is somewhat akin to Robert Kiyosaki and some of the people that have done a lot of financial education, thinking differently, pay yourself first, these kinds of things. And I get particularly excited to talk to people about this being such a safe bucket and a secure place to put liquidity, right? To put funds, that I'm not too worried about someone that's a high earner putting more if they can do that. Part of that is this high cash value idea, right, Barry? We're using paid up additions, we're adding cash to the policy. And in exchange for doing that, you get some benefits that are only available to life insurance. And the other thing is, it's so advantageous that the IRS actually puts a limit on how much can be put into the policy and still call it life insurance. This is not smoke and mirrors. This is a real thing that offers a number of advantages that we're going to get into. But it's so advantageous that the IRS actually limits how much you can put in. Interesting aspect of this.
Yeah, great point, Steve. The Wall Street Journal has called this the tax shelter of the rich. And the IRS has basically put their stamp of approval on it by saying, yeah, you can stuff a lot of cash into these policies, but we are going to limit it.
And that limitation is called MEC, or the Modified Endowment Contract. You just have to know that the policy needs to be designed properly by an expert so that you can maximize the cash value in it and still stay within the MEC limits.
And Steve, you mentioned that MEC limit.
Mm-hmm.
My simple drawing here, to keep it as basic as possible, shows us that we use what's called a paid up additions rider to maximize the cash value. However, we want the least amount of premium going to pay for the whole life insurance. We call that base premium. The majority of the premium going to PUA maximizes cash value. We take that right up to the MEC limit. And in order to raise the MEC limit, we'll often use a term rider, which either has very little cost or no cost to it. And in that case, you get the most optimum policy and design out there. We're going to look at two case studies. The first case study is a 35-year-old doctor, and he's going to put in his solo 401k contribution of $58,000 a year. Whether you decide to double this or cut it in half, again, that's up to you as a doctor or medical professional. In this case, at $58,000 a year, we're showing the premium run through the age of 60. Now, I'm going to point a few things out. Number one, if this $58,000 were all going into base premium, this doctor would have $0 of cash value, Steve, in the first year. And it would be very slow cash value growth. But because of the paid up additions rider, the first year cash value is over $46,000. Most of his money or her money goes straight to cash value. Well, what does that mean? This $46,000 is liquid. This is an investment type of approach, but it's guaranteed. And there's a $2.2 million life insurance asset here that can be used for family. It can be used for business. Some doctors like to invest in real estate. You could use this as an asset for collateralization. We call it a collateral assignment with a bank. But check this out. This $2.2 million isn't all whole life insurance. This doctor's only purchasing $687,000 of whole life insurance. The remaining death benefit is coming from that term rider, which has a very low cost to it. So it's enhancing the efficiency of the policy. Every year, the cash value is growing because there is a guarantee and a dividend is being paid, and it's growing on a compound growth curve because there are no losses. You can't lose money in a whole life policy because it's fully guaranteed by a mutual insurance company. The net result or end result here, 25 years of funding, the $58,000, $1.4 million has gone in with $2.8 million in tax-free money. Now, what if this doctor says at age 61, I don't want to put in any more premium. I'm done, but I want to retire at 65. Now the cash value, Steve, has grown to $3.6 million. So there's two things I want you to think about this as you're listening. Number one, 3.6 million tax free, depending on your tax bracket, is going to spend more like 4.4, 4.8 million taxable. But two, this doctor, when they do decide to take out income, they're not going to take $3.5 million out in 1 year for income. They're going to take it incrementally, kind of like Social Security. As they're taking it out incrementally, maybe it's 50,000 a year, 100,000 a year, whatever the case might be, we do those numbers together. The remaining balance of the money, Steve, is still earning interest and dividends. And whatever's left over in death benefit, because you don't pay loans back in retirement, those come off the death benefit, they'll still be able to leave several million tax-free to their heirs as well.
Yeah, that is powerful. I think there's so many things in here that as you're talking, Barry, I think people need to just probably process it. However, I'll ask you just things that come up for me. Did the term coverage drop off on this one?
It didn't. In this case, it converted over every year to whole life insurance. So not only did the doctor just pay for $687,000 of whole life, that's all they ever paid for, but they also got a growing death benefit. And inside of that death benefit is both whole life and term, and eventually the term goes away and it's pure whole life. But if there were a premature death, truly this is the death benefit that would be paid out. So in any year that they might pass away, although it's term and whole life, this is a real death benefit that would be paid to their heirs.
Interesting. And it doesn't expire. In other words, the death benefit that we're seeing is a permanent death benefit.
That's correct. Unlike term insurance, that it will eventually go away. Yeah.
Yeah. And I just making a point, you see objections to whatever it is, infinite banking, whole life. A lot of times the recommendation is to go ahead and buy term and quote, invest the difference. And in reality, term is being utilized for this in order to maximize the cash value. And then the other thing that you pointed out, Barry, is I think people need to be aware of that you've got a guaranteed growth of the cash over here. And this is the non-guaranteed portion of the illustration that basically refers to dividends, correct?
Correct. The guarantees are inside of those cash values as well.
Yep. And this is why we get so excited, because if you've got something that is predictable growing asset, I mean, if you think about what's out there, a liquid, predictable growing asset as a safe bucket in your pie chart of what constitutes your assets.
Yeah, I don't know anywhere else. I've done this for over 20 years, and I've looked at many, many different types of investments out there. In my opinion, this is the most powerful financial tool that you can have in your portfolio because you're getting so many benefits at the same time. Your dollars are doing multiple things.
Well, right now, Barry, when you talk about taking out money, are you talking about policy loans or are you talking about withdrawing cash out of the policy?
So as you're early in life using this cash, you're going to take a policy loan so that you can pay it back. The idea of infinite banking, take a policy loan and use that to either invest back into your business. A lot of doctors, Steve, are leasing equipment. They don't realize on the back end, they might be paying a high interest rate on that particular lease. My advice is take a policy loan, buy the equipment with cash, pay yourself back the interest that would have been going to the financial institution. In retirement, you don't pay the loans back. In retirement, the general rule of thumb is you withdraw up to your basis of 1.45 million that you put in. And because that's money that you already paid tax on, that money comes out tax-free. Once you exhaust the basis of 1.45 million, then you start loans, but you don't pay the loans back. Those will simply be reduced from your total death benefit upon your passing. The idea is you don't cancel the policy, you don't terminate it, you don't surrender it. You simply stop paying the premium when you're ready, keep the policy in force until you pass away. That keeps everything tax-free, and then your beneficiaries get the difference in the tax-free death benefit.
It's exciting. And I know we're going to touch on policy loans a little more. How long does it take to get one, Barry, typically?
For most companies, you can take a policy loan in the very first year. I recommend you let it build for a few years, but contractually, you can take a loan in the very first year.
And it's pretty easy to get. You just ask the company.
That's right. No credit check. No application. They don't question you what you need the money for, and they usually do a direct deposit into your bank account within 3 to 7 business days.
All right, and this is an important point for doctors. I'm just going to make a point. So if you're to buy a piece of real estate, we're all familiar with real estate and that it can gain equity, right? And then you maybe could do an equity, a HELOC or something to get some money out of it if you needed to leverage it. Well, in a way, we're talking about that, except that we're talking about your total discretion and flexibility over the funds. So, and instead of applying for it, you just get it. So you got a liquid asset that you're leveraging. The other aspect of this is I just recently heard that some banks now are refusing to allow HELOCs. If you're a real estate buff, you might scratch your head on that. This is where I think becoming your own banker comes to bear too within these policies. That you have discretion, you have control of the asset, you've got control of the cash value. It's somewhat akin to a piece of real estate, except you hold all the cards.
That's exactly right, Steve. And we haven't even touched this, but this is one of the most powerful points that we can make in this whole life illustration. And that is when you take a policy loan, the life insurance company doesn't physically remove the money from your cash value. So if you get to year 5 or 6 and you want to borrow 400 grand or 300 grand, your full cash value is still earning interest and dividends. They put a lien against your cash value, but all of your cash is still working for you inside of the policy. In other words, you don't break the compound growth curve, and there's no lost opportunity cost when you do take a policy loan.
Yeah, that's an amazing point. So in other words, both your guaranteed growth continues, which, by the way, far exceeds what you can expect from real estate, just from the standpoint of guaranteed growth in and of itself. So that continues, and then dividends will continue as well.
That is correct. The other thing I want to point out, and this is huge, and it's flexibility. For the doctor looking at this saying, I don't know if I'll fund 58 grand for the next 25 years. Well, you don't have to. I naturally built in flexibility. What that means, this policy in particular for this 35-year-old doctor has the ability to reduce to about $13,000 a year in any year. You don't have to wait till you're 65 or 66. In year 2 or 3, you could reduce to $13,000 or any amount in between, Steve. It's a very, very flexible plan.
It's exciting. That flexibility, Barry, is within the paid up additions, correct?
That is correct. Let's look at case study number 2. What if the doctor is a little older? In this case, I'm using a 50-year-old doctor. And at the age of 50, remember in a solo 401k, there's that catch-up provision where you can put in an extra $6,500. So I used $58,000 plus the $6,500 for a $64,500 annual premium. Again, we're not telling you to do this. You could double it, you could cut it in half. These numbers in these illustrations are very linear, meaning you could say, well, if I put in 32,000, what would my cash value look like? Just cut these numbers in half. All right. Here's a 50-year-old doctor wanting to play catch up. They're going to go to 64,500 in an annual premium, and they're sitting on some cash. So they want to add an additional $100,000 in lump sum money in the first year. So they're really turbocharging this cash value. In year 1, the total annual outlay then is $164,500. Now this is remarkable. This is a high early cash value policy. The other one we looked at is amazing too, but this just really turbocharges things. Notice the cash value here, Steve, is $155,000. When I do the math on this, 155,338 divide 164,500, over 94% of this doctor's premium is immediately available in cash value.
And you've got a whopping death benefit there, it looks like.
Yep, well. 3.2 million. However, because of this design, this 50-year-old doctor is only paying for $787,000 of whole life insurance. The remaining term insurance of about 2.4 million. Look at this. No out-of-pocket cost for that. We drop off this term rider after the 7th year because we don't need it after the 7th year, we've met the MEC guideline, the requirement. So in year 8, although it does reduce from 3.9 million down to 2.1, the 2.1 is still much higher than what they originally paid for in the 787 whole life policy.
Wow, it's exciting.
Yeah, the cash value is liquid, can be used for whatever they would like. If the doctor at age 58 decides they still want a $4 million death benefit, we don't have to drop off the term rider. That again is a natural built-in flexible option that we create within the policy. A lot of flexibility here. I ran this design through the age of 68, assuming retirement, and starting at 69, no more money going in. They're done funding. Yet look at this. The cash value is still growing by 85, 90, 95,000 a year with no more premiums going in.
And keep in mind, what Barry's showing is that's liquidity right there. That's ready, tax-advantaged money. It's a much different animal than what you might be familiar with in terms of retirement accounts, and these kinds of things. So it's powerful.
Great. Steve, let's quickly talk about income, because as good as this is, the doctor using cash throughout their working years and this policy is their own bank, when they get into retirement, they can now begin to use this cash value as tax-free income. We've talked about that briefly, but let's look at some real numbers. So in this illustration design, what I've done is I've shown the premium being funded through the age of 68 at the $64,500. Starting age 69 and then through the age of 70, the minimum premium of this $21,000 is going to be paid from dividends and cash value. The dividend is large enough here to cover all of that and then some. And starting at age 71, we're going to start taking out $120,000 of income completely tax-free. So for most doctors, that could feel like $150,000 to $200,000 taxable. $120,000 income for 20 years through the age of 90. You see the 120 coming out. Here we are at the age of 90, and we have to make an assumption that if the doctor passes away at the age of 90, they would have pulled out, we'll do a calculation here, 120,000 a year, 2.4 million. And that's all done on a $1.2 million contribution, those premiums over those 18 years. And Steve, if they pass away at the age of 90, having taken out $2.4 million in income tax-free, they still are able to leave a $733,000 tax-free death benefit to their heirs. So all total, 2.4 plus the 700,000, about 3.1 million going to them and to their heirs. That's remarkable for a $1.2 million premium over that 18-year time frame. And I want to be clear, multiple streams of income in retirement for a doctor would be key. There's going to be qualified money from 401ks, IRAs, perhaps they're going to sell their business and they'll have income from the business. Most of that is tax deferred and taxable. This would be the safe tax-free bucket of money that they're able to use and not having to worry about what tax rates will be in the future. Again, this is a part of the overall plan. And having this in your plan as a doctor gives you more options that you otherwise wouldn't have.
Yeah, absolutely. All right. So Barry, it's exciting to talk about this aspect of our safe bucket asset, right? But I don't want any confusion. So I want to preface what we're going to talk about by saying that we're not trying to compete with, quote, financial investments. I always talk about this. I know you do too. Whole life insurance, high cash value whole life being strictly a safe bucket asset. But the exciting thing is when you're thinking about that and looking at it, you just saw the illustration with the guaranteed and the projected dividends, which are really based on dividend rates, and those dividends go back hundreds of years. So when you look at the guaranteed, non-guaranteed, you can definitely calculate how your return is going in terms of the cash value guaranteed and then adding in dividends within the policy, right? So that's really what we want to do. And unfortunately, the financial people out there and the various groups, There is a battle for dollars, and return on investment. You guys and gals as doctors are hearing these different terms, and it's sort of put forth to be the end all be all, return on investment. In this case, we have guaranteed return, which puts the asset in its own echelon in and of itself. And then when Barry kind of dives into this and shows what really is going on, it gets pretty exciting because you realize that you have very solid return on cash and these kinds of things. So with that, Barry, I'll pass the baton over to you. I'm excited to hear a little more from your calculation perspective on what we're really looking at.
Thanks, Steve. And we're talking about an asset here that is guaranteed, it's liquid, it's tax-free. It's very difficult to categorize this the same as you would a stock market investment. I prefer not to, but a lot of people do. So we're going to go into that world and in that spirit, look at returns. I call it a guaranteed investment. Most market-based investments are not guaranteed. That's where they're lacking. So this is a guaranteed investment. And in the spirit of returns, let's take a look at some numbers. So first off, we're going to come back to the illustration on the 35-year-old. And remember, this 35-year-old doctor stopped funding at the age of 60, and age 61 put no more premium in. Some of this isn't completely accurate in a calculation, but I want you to get the 30,000-foot view of what I'm going to share, because there will be income taken out. However, if the money continued to grow, at age 80, 45 years in, we're sitting here at 7.59 million. What does that translate to in a rate of return? It's near 5%, 5% tax-free. And here's the calculator that I use for that. So what we see here is the 58,000 going into the policy for the 25-year time frame. And in the 26th year, there is no more premium going in. 45 years in, or the age of 80, here's our same 7.59 million. What does that translate to? It's almost a 5% rate of return, 4.96% in this case. Well, what does that mean, Steve? It means that although the cash value was negative the first few years because there's some capitalization time in an infinite banking plan, it is as if this doctor earned 5% tax-free every year, not just 45 years in, but the effective return on this policy is 5% tax-free every single year. No market volatility, nothing to worry about in regards to losing money. We see our 7.59 million here matching exactly what the illustration is showing, 7.59 million here. There's our rate of return example. Now, is everyone going to earn 5%? No. Some it might be higher, some it might be a little lower, but there is a guarantee. And we can show the guarantees here in the illustration. We've primarily been looking at the non-guaranteed numbers, but here's the guaranteed cash values. And it doesn't matter if you're in your 50s, 60s, 70s, the guarantees are always growing.
Yeah, Barry, and we've talked about this. I often feel that, and just based on experience with these things and looking at what's happening in the, on the other side of the road with the financial assets, it seems like the requirements require whole life to be sort of illustrated very conservatively on its worst day, perhaps. Whereas oftentimes you see, lots of big numbers and a lot of things going on with different kinds of financial investments that are really sort of touting that asset or that investment on its best day.
A lot of projections in a market-based investment will use a 20-year historical look back, which always looks better most of the time. I mean, I should say most of the time looks better. They're not doing this in the life insurance policy. They're taking today's dividend only and projecting it forward. If they did take the 20-year look back and we had those returns in the 2000s and after the crash of '08 and all that growth, it would look better. But they don't do that. So as you say, it's a very conservative approach. The reason the guaranteed numbers aren't accurate is because they simply don't include the dividend ever. But insurance companies are required to show an absolute worst case scenario. This company we're looking at in particular They've paid dividends for 174 years. They've never missed a single year of a dividend. So it isn't completely fair to only look at the guarantees. I show guarantees so that doctors can see you never lose money. But what is more accurate are the non-guaranteed values because they include the dividend. And Steve, once a dividend is paid by an insurance company, a mutual insurance company, it's locked in. It can never be taken from you. Unlike a stock dividend that if you reinvest that dividend and the stock value goes down, you could certainly lose that dividend.
Right. So we've talked a lot about continuous compounding growth by reinvesting dividends. I think that's something that if you're listening or just getting into this, you'll hear a little more about that as being part of the power of this whole approach.
Yep, correct. Steve, a little bit more social proof. We bring up the University of Michigan, and this story was done on Jim Harbaugh. Right here that I have highlighted, he was compensated specifically with millions of dollars of tax-free cash during retirement using the same strategy, a cash value whole life insurance policy. So this isn't just smoke and mirrors, as you mentioned earlier, that we're talking about. This is real life, actual financial strategy that can be placed into a doctor's portfolio to get all the remarkable benefits we've discussed: guarantees, liquidity, tax-free use of money, asset protection, death benefit to family, so many wonderful benefits. And here we have Jim Harbaugh doing this for that particular reason.
Awesome, Barry. And can you offer any insight to anyone listening as to why this isn't mainstream and everyone talking about this, perhaps the docs listening amongst their colleagues? Do you have a theory on that?
Yeah, and I've got a big smile on my face. And the reason why is because I get the question often, why isn't this more popular? I would say it is more popular than a lot of people think. However, when you look at the marketing done by the major financial institutions out there, right, the Wall Street people, the Fidelities, the Charles Schwabs, the Merrill Lynches, they want your money in the market because they earn fees. And the goal is they want to manage your money until you die because they're earning the fees off of your total portfolio. We don't get compensated as life insurance agents off your total portfolio. It's only based on the premiums you pay in a particular year. So one has to do with marketing. And they recognize in the Wall Street world, every dollar you put into a whole life policy is a dollar that they're not going to get in your 401k or your mutual funds or your IRA. It really comes down to dollars and cents.
Amazing. Yeah. And of course, the other factor in this, you might want to speak to this, is amongst life insurance people, experts, how many out of 10 are actually going to have a clear understanding of this strategy and be able to help somebody implement it?
I can't even say 1 out of 10. And I coach and mentor hundreds of advisors throughout the country about infinite banking. I say it simply because most advisors don't understand it. They'll sell you a traditional whole life policy. It's probably more like 1 in 100 that understand how to do it. And that number could be generous.
Yep. It's a niche, an understanding, an expertise. It's something that can be a gem. So to summarize, you've got a lot of different aspects of this that are exciting. And I did say that we would touch on some bonus items at the end. One of those is the asset protection piece, which I know doctors are always very attuned to. What can I do for asset protection? How can I protect my assets from judgment creditors? So in addition to all these other things for supporting your business, for having an ability to take liquid cash and use for business equipment inventory, growth of the practice, in addition to tax-free retirement income, we also have this idea of shielding cash value from judgment creditors.
Steve, we've talked a lot about tax, but as we just wrap up my little drawing here, that when I present this to doctors, my question is, where are you currently saving and investing money? Most doctors, it's tax deferred or taxable. And when I draw out tax-free and I share with them these 3 tax buckets, my question is, well, which one do you like the most? Most doctors, and I say most, it's usually 10 out of 10, tell me tax-free. But the next question I ask is telling, and that is, where is the majority of your money? And they'll say tax deferred. What I want to help doctors with is shift that. Shift it so now they have the majority of their money or a good portion of their money into tax-free buckets. And the infinite banking plan is the most powerful tool to get it there.
Yeah, Barry, I'll just add to that. We're seeing it more and more. We're seeing the idea of people kind of questioning whether they should keep their entire 401k, these kind of questions. It's case by case. Everybody needs to do what's right for them and look at the various pros and cons. But I'm personally seeing more people in the current climate sort of wonder how the tax rates are going to be, what's going to happen and these kind of things. So certainly something to consider in terms of moving at least a portion into that preferred third category that you were mentioning there. All right, bonus time. We do have a page on our website. A thing to be aware of: some states are better than others. Cash value life insurance has creditor protection. So in addition to all these other things and liquidity and advantages, you've got state by state asset protection of the cash value, which I know as a doctor that's going to resonate as a huge bonus item for you. To wrap up, remember that we've been talking about this bundle of benefits. And for my part as an estate planner, you have a lot of different things that you're obtaining when you do this kind of a strategy for a portion of your assets. So you got the participating policy, which is a mutual company, dividend, tax advantages, tax advantage or tax-free use of money, collateral for making investments in other areas. So this is a leverageable asset, but unlike real estate, you don't have to apply for it. It's not cumbersome, doesn't hit your credit. You have a death benefit that's going to be a growing death benefit, as Barry pointed out in his examples. And of course, the list goes on. I'm going to lob it over to Barry for one more huge aspect of this some bonus items that go along with these policies. Barry, do you want to talk about that?
Yeah, Stephen, a lot of these policies, doctors get a free chronic illness, terminal illness, and critical illness benefit where they can access death benefit while they're still alive. There's no out-of-pocket cost for that. And no doctor knows what their future holds. So to be able to tap into death benefit while you're still living, we call these living benefits, can also be another huge advantage to you in your overall portfolio.
Very good. And many of you doctors listening, you may be aware that chronic care, that's a unique area of coverage. Rather than have to just spend your cash on that, it's nice to have that option if you ever need that kind of care that's not covered by a lot of other kinds of insurance.
Steve, as we wrap up, properly structured infinite banking, so many benefits. We've gotten into a lot of them today. The main four: guaranteed, liquid, protected, tax advantage. I always say to doctors out there, look at your own numbers. If you're interested in what we've shared today, take the next step. I put numbers together for you, and then we can refine based on your particular goals. But that's really when the light bulb comes on, because you're seeing the numbers for yourself, your own age, your own health, your own goals. And it will make a lot of sense when you begin to think about this in your own portfolio.
It's exciting. And of course, we're holistic about this for you listening. We want to partner with you in terms of your practice and how this can complement not only you and your loved ones, but your practice and your overall wealth plan. We're excited to talk to you, invite you to take that next step. There is a button below this webinar. Click it, then you'll complete a few questions. We just do that to kind of get a better idea of your scenario. You'll be able to schedule your first connection with Barry to go over some details. With that, thank you so much for joining us. Have a great day.